Welcome back to Soar Financially. My name is Kai Hoffman. I'm the @JR Mining guy on Twitter, also the CEO of the Soar Financial Group. Tremendously appreciate you joining us here today because we're joined by John Kaiser. He's the editor, publisher, founder, owner of Kaiser Research. Really looking forward to the conversation here with him in a second because we're going to break down how the geopolitical events that are happening right now, and geopolitical, what you call it, like how the geopolitical landscape is shaping up right now, affecting junior resource companies, junior resource stocks, but also the commodities. Really interesting discussion. I just had a chance with him, or to chat with him before hitting the record button, and I think we got a doozy in our hands here. So I'm really looking forward to the next 25 minutes here chatting with him. John, it's great to have you on. Thanks so much for coming to the studio.
Kai, I'm so glad you were able to grab me and find the time to bring me into your studio.
Absolutely. No, I really appreciate it. You had to walk over from the conference I pulled you out of. So
it was beautiful. It was beautiful walk today. This is not Vancouver-like at all.
Absolutely. Didn't need an umbrella. It's 25 degrees out. And I apologize for wearing a t-shirt, but it usually gets a bit warm in here as well because the sun hits the office from this side as well. So, but no, it's great to have you. Let's dive in. Let's start with a bit of a macro, quite a holistic question. Like, in your opinion, what's the current, the state of the market? And I mean, commodities and economy in general.
Okay, the global economy is, of course, not growing as quickly as people had hoped because of the interest rate hikes to subdue inflation, which turned out to be more persistent than anybody expected in 2021 when we relaxed all the restrictions. One of the things that's really hanging on the market right now is that China, which had that zero COVID policy, which subdued its own economic growth, and which also created a lot of the supply chain problems that have not 100% but partly fed into the inflation problems we have. When they finally abandoned zero COVID in October, there was great expectations that China would rebound in a big way. But that has not happened. What we're seeing is subdued demand in their own electric vehicle sector. So a lot of commodity prices have come down, including ones that are related to the whole energy transition in the past 5 months. And we didn't yet know this in January when I was at the Vancouver Metals Investor Forum conference, and the buzz was tremendous. It was biggest audience I'd ever seen at this type of conference. And I thought, wow, we're finally emerging into a full-blown bull market for the resource juniors, because the resource juniors are potential suppliers. And the key sort of backdrop that I've developed is that there's two drivers that are going to make the juniors important again. And right now, the juniors are not important at all. Nobody cares about it. Value traded has been diminishing. It's not as bad as it was in 2018, 19, but the market right now just doesn't get it. And the big geopolitical conflict is that shaping up between China and the United States for domination of the global economy. And it's been packaged as a showdown between autocracy and democracy, but that's a bit of a false split. That's going back to the old Cold War conflict between the Soviet Union and the United States, where it was capitalism versus communism. This conflict is different, and it's become very prominent since China decided that when Russia invaded Ukraine, it was going to side with Russia and support it and not be in any way behind sanctions of anything. And the interesting thing that's emerged is that the global West and the global East, the global West being sort of Europe, Canada, United States, Australia, Japan, Korea, all the sort of countries that are sort of full-blown democracies, and global East being China, Russia, Iran, and other sort of full-blown autocracies. There's the global South, which is like much of Latin America, a part of Africa, and much of Southeast Asia, and India and that Southern Asia project. And these are countries that they're still emerging. For example, India and South Africa and Brazil are part of the BRICS, the three BRICS that are still democracies of sort. But they're looking at this conflict. They're not sure who's going to win. And they're thinking, what's in it for me? So they're sitting out on these votes at the UN on the resolution to condemn Russia's invasion of Ukraine. They're not joining the sanctions. So it is now a triangular conflict. And this is what's going to be very interesting going forward. In the energy transition, we can talk about that later. That's something that's actually a problem for everybody, which is what makes that one really interesting.
Now, you talk commodity price, and I want to start there because you mentioned now the U.S.-China conflict, Cold War II. I call it Cold War II because it's definitely the second part of what we've seen in the past between Russia and the rest of the world. I'm looking at the commodity prices, copper, silver even, and are there recession fears already being priced in as well in the U.S.? So
this is the odd thing. Like you look.
I'm looking for a lot of reasons, by the way, that fits together because there's so much going on.
Yeah.
Right.
So the Dow Jones is the stocks that make that up. It has not come back. It did not suffer as severely as all the other indices and companies. It's hanging up there as if it's oblivious to what is going on. But the retreat that we've seen in the metal prices and in copper, in iron, in nickel, zinc was riding really high, and it's now back to $1.10 a pound. That market is seeing a recession coming, and the interest rates that are of course a problem. That without the debt ceiling could still push the United States and the rest of the global economy into a recession. And the debt ceiling, if they actually allow it to come to a default, well, then we're in a no man's land that's never been experienced. So who knows how high yields will go and what the negative impact will be. So it's kind of weird. The commodity sector has been like the canary in the coal mine, signaling that we don't like what's coming. And it's had the physical impact of subdued or slowing demand from China, despite its post-zero COVID policy, and that's why we're seeing this nose. I think once we get past this debt ceiling show and find out what the consequences are or what they end up doing, we might end up back into an uptrend. But right now, it's like a Damocles sword hanging over the market's head.
You brought up the debt ceiling. Let's stay on that for a second. Like we've seen back in the past, I think it was 2011. I'm not 100% sure. We saw furloughs where teachers got I wouldn't say laid off, but they didn't get paid, right? And schools were closed, national parks were closed. Do you see that happening again? Like, what's your, give me a percentage, maybe scenario of the debt ceiling being resolved before it becomes critical?
Well, the debt ceiling is so critical to this global South, global West and East conflict, because already with the sanctions put on Russia after the invasion of Ukraine early last year, many countries have not joined. In fact, 125 countries never voted for that UN resolution. And the United States, because the US dollar is the primary reserve currency and is also the currency in which global economic transactions are cleared at, and it's also used for price discovery. So there really isn't obvious replacement for it unless you link the renminbi to the US dollar. So and of course they park their proceeds from their sales in treasury bills. So making this thing unreliable is creating huge credibility concerns in the rest of the world. And in my view, I think whether or not they pave this over for now and punt it down the road, the rest of the world's thinking we need to get away from the US dollar as what we rely on to clear trades. And if we do see the split between global West and global East widen so that the global economy fragments into separate zones, the US dollar won't be part of it. But if we go the scenario of the debt ceiling really causing everything to crash, that might even ultimately lead to the breakup of the United States itself, because the pressure between the so-called right wing and the left wing, when it's really like just extreme right wing versus the middle and the crazies on the left, the United States will not survive if it goes into a kind of world where you have an autocrat or a wannabe autocrat in charge, and they are legislating women away reproductive rights from women, turning gayness into something that's a crime, and even supporting racism in various ways, replacement theory and stuff like that. The country cannot survive. California has a bigger population and GDP than Canada. And that country, even though it has its share of Republicans and the majority of Democrats, its culture, however, is not one that would want to have religious dogma dictated to it from Washington. And the thing about the debt ceiling is I think if it is allowed to default and the chaos it creates, it probably means that the Democrats will not be reelected in 2024. So that's kind of a really negative scenario. It's totally crazy too. I've looked at what the U.S. government spends its money on, and the two key categories are Medicare and Social Security. That's the boomers. They're not touching that. That's 30% or so of the total spending. Then there's two other categories called income security and health. And I think that includes welfare and Medicaid and who knows what. And that's what goes to the younger people. And that's where they do want to make cuts. And then there's things you won't touch, like defense, which is 12%, net interest, which is 10%, going to rise with these higher interest. And then there's this whole collection of smaller things which they think they can cut. But even when they cut them, all they do is emasculate America's ability to get stuff done. Now, those people who say anything run by the government is counterproductive to getting anything done, but I don't think that's actually true. These government institutions play very important roles in making sure the whole economy runs smoothly and fairly. So I don't know how they're going to resolve this. Do they take the boots to the boomers, the last of which will be 65 by, I think, 2029? Or do they go to war against the people who are still working and whose taxes will be paying for the Medicare and Social Security, which is much bigger than what all those people put in because they're all living way longer than was assumed when the original contributions were defined.
Interesting. No, those are some interesting comments. And I'm going to ask you a question. I don't think I've ever asked anybody else on the podcast, like, what would a default actually look like? Okay, so the U.S. defaults. They say, okay, we can't pay our interest, we can't raise the debt, we can't issue more debt. What does it look like? What's the scenario? What's day one afterwards? Like, for me, I see people burning in the streets and cars burning in my head. Like, a lot of doom and gloom.
Well, the immediate consequence is the T-bills that come due, and you're supposed to pay out cash to them. It's not going to happen. So it's like, oh, well, the check is in the mail. Well, why isn't it coming here? So everybody who's counting on that check in the mail, they're going to have to react in some way. I don't think it really results in blood in the streets or anything like that. But I think the general equities, they will probably tank. Because when you see a lot of the central banks in the world wanting to lighten up on their U.S. Treasury bills that are part of their foreign reserves. Well, the way you do that is you hit the bid, which means that the yield goes up. So you're going to see soaring interest rates, and you have a huge real estate pyramid in the United States. And right now, commercial real estate is the nightmare because COVID really changed this usage of being in the office to get your work done. This working from home is not going away. So there's these huge overpriced commercial real estate portfolios held by pension funds and all kinds of things through these REITs. That's going to take a big hit. So when you see the optics of these asset values declining precipitously, I'm not sure how that will translate to the ordinary person, but you might see more inflation too, because the cost of stuff that comes from China, like what portion of Walmart's shelves doesn't come from China?
No. Sure.
So those prices will go up. And inflation is what makes people angry. Those kinds of people who buy Cocoa Puffs are absolutely pissed that it costs $8 for what used to cost $3, or a bag of chips now $5 instead of $2.50. And that's way more than the actual inflation has been. So that could cause a lot of turmoil out there in the streets. But it's really unknown territory. It's never happened before.
Yeah. Now, interesting. I'm really thinking about, you mentioned de-dollarization, new currency, big reset. Those buzzwords keep coming to mind when you say default, right? Hitting the reset button, or that would be an opportunity to hit the reset button, issue digital currencies maybe even. Those are scenarios that are going through my head as well. Is that realistic?
I think whether or not a default happens, I think the desire is there to transition away from relying on the US dollar. But it cannot happen overnight. This is why I think gold, after waiting 30 years for it to really start increasing real price. I mean, do you realize that you take $400 gold in 1980 and inflation adjusted by the US CPI, you end up with about $1,521, where it's kind of kept track with inflation. But the reason nobody's excited with gold at $1,900, $2,000 is because the costs of mining gold have gone up, and we've doubled the above ground stock of gold since 1980 as a result of those initial increases. So the low-hanging fruit, the better grade stuff or the lower grade stuff that was near surface, it has largely been exploited. So in order to really get some life into the juniors that are looking for gold, we need to see a real price increase. And right now there's this battle in the market. Is $2,000 going to remain the ceiling for gold, that it sort of tries to bump through and then always fails and goes back to 1,700? Or is it going to become the base from which it can launch to $2,000? And I think we are at the cusp of this happening, where we will see a real price increase into the $2,500 to $3,000 level. That's real, not just tracking inflation. And this assumes like inflation manages to stay 5% or something like that. And as you know, that would only be from 2,000. That would only be 20% gain, but that has massive leverage on ounces in the ground, and also for existing mining operations. So it's the real price gain. And my peers, they yap about fiat currency debasement and inflation and that. None of that is useful to the resource juniors, what they're trying to accomplish.
Now, I listened to your Kaiser Watch on your YouTube channel, the last episode here, and you mentioned that higher gold price allows to make lower grade deposits economic.
Yes.
So I want to give you a counter argument, or I wouldn't say a counter argument, but food for thought. Newmont is now producing at $1,375 all-in cost. Despite higher gold prices, the margins actually have shrunk because gold came down, cost went up, but not as a pair trade. Like, it wasn't linear, right? So my question is, like, when, let's say we have $2,500 gold, $3,000 gold, costs should be much higher because we see wage inflation and other things. Like, do you see there's a limit to it? Like,
I mean, if costs keep going up, and one reason the mining sector suffers is that when we see these general inflation numbers, it's always worse for operating costs and capex. That always is more. That's why every time we're waiting for the next feasibility study update or so, we're expecting escalation of capital cost and operating cost assumptions that swallow up whatever gain gold has accomplished. But where were you going with that question?
No, it's like you said, like lower grade deposits will become economic.
That's why I say the real price increase. Forget inflation. The real price comes from increased demand. What would cause increased demand for gold beyond trying to just track inflation? And that's why I think this power struggle between the United States and China for domination of the global economy, this is going to stimulate as a transition real new demand. And what's interesting is in the past year, I watched the GLD gold going in and out. It has largely been flat in terms of how many ounces it holds, and yet we've seen gold rising. That means there's a different type of buyer in the market for gold. And central banks have been described as accumulating a lot more gold in the past. But when you look at the net numbers, last year was actually one of the lower years where the increase in official holdings increase. It was actually much lower than prior years. From 2008 on, it's been steady, whereas before that, everybody was liquidating their central bank holdings. But the reason that this is not a correct description of what's going on is that some of these distressed autocracies, I think such as Venezuela and Iran, have been selling gold because they've got such brutal sanctions against them. But other ones, and I think these are the ones that are in the sort of global south, they have been buying gold, but that has been masked by this stress selling, which is not going to last forever because they'll eventually run out of gold to sell. But the desire to convert, say, U.S. Treasury instruments into gold that is going to keep increasing. And I think it's the optics for the retail market and the institutional market. They want to see this uptrend. The reason for why it should continue is already in place, but it's not really believed. And I think we will see this happen. And that's where you will see the price of gold outstrip the increase in the OPEX and CAPEX.
Okay. Fantastic. I appreciate the answer there. It's like I was wondering, I wanted to challenge you. I wouldn't say challenge, but it's like get your thinking on that, like how that works, right? How are you bottom fishing now? Like, where are you bottom fishing? Like, where are you throwing the lure in? Where are you looking? What are you targeting?
Well, geographically, I'm I watched what Mexico just did with their sneaky little new mining law that they passed by taking all the Morena Party members into another room and holding a vote while the opposition's in the wrong room complaining about the upcoming vote. And this changes the mining concession application system in a way that for juniors, especially ones doing grassroots exploration, new ideas on that, it's dead. Mexico's dead unless this gets reversed and they come up with an alternative. In a lot of these countries, you're seeing resource nationalism. South America is becoming pretty bad. When Gabriel Boric of Chile suddenly said, we don't have enough of a stranglehold on the lithium leases that we already have. We need to declare a different sort of right to use regime. And we'll talk about this later, but this suddenly put Chile's ability to serve the expansion needs of the lithium sector for the EV 2030 goals, that kind of puts it on ice because everything is now limbo. So I'm retreating to places like Canada, Africa. The Chinese and the Russians are in there. They can outcompete and outbribe anybody. In fact, it's illegal for Western companies to bribe this, where it isn't for Russians and Chinese to do so. So it's like I'm going back to the 1980s when I started in this sector, when all exploration was all about Canada with some in the United States. Australia, of course, is a fantastic place. I think Australia is undergoing a tremendous boom. So I'd be looking at Australia, Canada, and the United States, maybe Scandinavia, though places like Sweden seem determined never to approve any mine anymore. But that, in geographical terms, I'm avoiding those sectors. So in terms of what I'm looking for, bottom fishing has become tough. For 2022, I had 150 companies tagged, and they all pretty much did nothing. This year, I only retagged and added a few for a total of 40.
Can I ask what commodity they're in?
Bottom fish are across the board. A bottom fish is something where there's a missing piece. It could be a permit, it could be money, it could be the price of the metal, it could be the competence of the management in terms of promotion and stuff like that. That's how you make money in this junior sector, is you find something where there's a missing piece, figure out what it is, assess the odds of it actually falling into place, buy it where there is this high risk and the market's ignoring it, and then you get your rapid 300 to 500% gain just as the stock finally starts being priced as, this is an alive and well story. So in the last while, I've been looking at juniors that have competent exploration teams, that have projects where there are interesting ideas. There's various stages of project development, some optionality type plays, but I've also skewed it towards lithium because I think what's happening to lithium is absolutely unprecedented in the history, in the metallic history of the world, both in terms of scale and the time frame within which it's expected to unfold.
Okay, interesting. Lithium is, how much lithium do we need? I think that's a big question. And I think maybe we'll start there because there are lithium juniors popping up left, right, and center. And again, I'm seeing deja vu moments from 2016, maybe 2017, or 2015 to 17 maybe, where we had too many graphite juniors pop up, some cobalt chunk coming to market, even some lithium guys, like lithium brines, they were on the side of a mountain instead of actually in the valley or in the salars where they needed to be, right? So let's start is how much lithium do we need, and how do we find the companies that it could actually be beneficial to that energy transition there?
Well, first the backdrop. In 2005, the lithium market was worth all of $200 million. It was like a nothing burger. And it was supplied by the big giant Greenbushes pegmatite in Western Australia and by the Chilean brines, which came on stream. And this went largely into ceramic and glassware applications and various industrial applications, all of which were just tracking the growth of the economy. The lithium-ion battery changed everything. And there was the first Lithium Mania 1.0, as I call it, it broke out in 2015 because that's when we started seeing people actually buying Teslas. Before that, this was a pipe dream, never going to happen. And that's where all of a sudden all these companies picked up all these brine projects, and the Australians went absolutely nuts because much of Australia is this barren landscape where these things were sticking out of the ground. And so when they realized what was happening to the lithium price and the future demand, and this is the key thing, it's the demand growth expectations that are key. They went and staked all this stuff, and these crappy little companies like Pilbara Minerals, they're now $15 billion companies, and they're producing this stuff, open pit mining. It was there for the taking, sticking out of the ground. And they crashed the price of lithium because the EV growth trajectory wasn't as good as the efficiency of Australian developers and miners mobilizing new supply. So it crashed in 2018-19. It crashed below $3 a pound from the $10 to $15 a pound lithium carbonate range. And this, of course, killed all the juniors. Many of them, especially the Canadian ones, they didn't even get around to drilling. Like Patriot Battery had this Corvette project back in 2015, but they never drilled it because the lithium price collapsed. And I kind of sat it out. I hadn't really done my homework on the future demand or where this could come from. I assumed that the Chileans and the others, like maybe even Bolivia with its huge resources, and Argentina, they would mobilize all the lithium that the world would ever need to fit, complete replacement of ICE cars with lithium-ion battery motors. And it wasn't until early last year that I understood that something had changed. And I started reading these government reports, like from the International Energy Agency. And they're actually just related to EV expectations for 2030 to meet their net zero emissions goals by 2050. They're talking copper needs to increase 50% by 2030. This is above and beyond the macroeconomic growth. This is why, I'm calling copper now red gold. There's yellow gold I'm bullish on. There's red gold, and lithium is the white gold. But they were saying it's they need 600% more. And so I did the numbers, and I follow what the USGS publishes. And in 2021, it was 100,000 tons of lithium metal equivalent. Last year, it was 130,000 tons. And when I do the math, we're talking, and assume that $10 a pound is what you're going to need to make this happen, because you get too cheap, it just isn't going to happen. We're talking about this market that used to be $200 million becoming worth $100 to $200 billion by 2030. That puts it in the league of copper and gold, puts it above, beyond zinc and nickel. It's incredible. And where's half of it's going to come from Australia, the pegmatite's there. They still got lots more to find and develop. And also the brines. They're going to get their act together and mobilize a lot. And then there's the direct lithium extraction from the oil field brines, which are still kind of a wild card. It's a technological question. It could provide an awful lot, though we don't know at what price. But the other half has to come from pegmatite deposits. And that's where Canada, they found countless pegmatites while looking for gold and base metals through the past many decades of exploration. And they would note it, but because it was a tiny market, they didn't even bother seeing whether it was the lithium kind or just the barren kind. And this is all there right now. And what started last year, and Brunswick, which is one of the companies I adopted last year as a bottom fisher, Bob Werza realized, like me, he'd missed the boat the first time. He thought, okay. And he's seeing what's happening. He says, now is it too late? No, it wasn't too late. Because the first wave in 2015 to 17, they picked out all the cherries, the big ones that stuck out of the ground, pasted postage stamps, claims on it, and worked on upgrading them. And so we've got the projects. RockTech has one. There's the ones that blew up on Namaska, Wabuchi, which is now owned by Levant and the government, and the CYR, which was Paul Matizig's Lithium 1 grabbed that even earlier than Lithium 1.0. It was in that 2010 to 2012 rare earth mania period when lithium was also seen as a future, electric vehicle metal. That ended up being acquired by an Australian company, which Allchem then acquired. But what's happening now with the realization that we need to 6 times more, and half of that's not going to come from the places where it's coming from now. Canada is one of the best jurisdictions. Now, Brazil is also good. Africa is good, Zimbabwe, but the politics is so messed up in these places. I wouldn't count on anything coming from these places. And there's now over 200 little Canadian juniors. And when the rare earth bubble happened in 2009, people were saying, "Oh, that's way too many." But with rare earths, you only needed to come up with a handful to provide some balance to what all primarily comes from China. But China itself can't supply all the new lithium. It's got some lithium supply, but it can't do it all. So 200 companies could literally come up with a 10 million ton deposit of 1% or better. So let me catch my breath and let you ask a further question on that.
I was going to sort of put a wrap-up question around it as well, because we're coming up, I feel like, to a very slow period in the markets now. So I'm curious, what your prediction is for the next 3 months for the commodities and for the junior market in general. We're here now, what is it, May 26th right now, we're recording this. I think June, as soon as North America disappears into their summer break, Europe is going to be online a little longer. But until the end of August, I'm expecting a slow summer. Personally, that's my opinion, just based on what I'm seeing. Macro events will influence that, obviously. But what is your prediction? What does your gut tell you? How is the summer going to go?
I think this summer we're going to see an absolute explosion of speculative activity, primarily in lithium, because I know what's happening with lithium. With gold, I don't know how long it takes for all this.
Can I jump in real quick? Sorry, with the lithium, because we're going to finally see some drill results.
No, it's not about drill results. No. What's fascinating is the market kind of stalled this year because lithium spent all of 2022 between $30 and $35 a pound, and that's way too high. That was like a temporary aberration because of the supply-demand balance reversing in the other direction, and the poor car makers and battery makers getting screwed in the process. But the producers, they had longer-term contracts, so they didn't exactly collect 30, 35. But with all these contracts running out, there was now pretty much a concerted effort to bring this stuff down. And we literally watched the lithium carbonate price be like a bungee jumper going straight down. And we were on the sidelines watching, did they calculate this rope correctly and my weight? Am I going to go through $10 and hit $5 and be completely dead? Well, it got to about $11 and it's bounced back to $19 a pound. And so now we're going to see this oscillation. So the stress that it may all die again, that's out of the system. But the summer is there's been tremendous archival research. Everybody's been combing all these Canadian assessment reports, finding these reports of pegmatites, figuring out what the geological context is, where, seeing if the claims are open and staking it. And for example, one of the companies in my session, Beyond Minerals, they picked up the entire 60-plus property portfolio that a pair of prospectors had assembled in Ontario. Brunswick has done similar archival research in the past year, and it has a lot of exposure in Quebec. But in most of these cases, that there's never been any drill holes. They don't know exactly where this patch of outcropping pegmatite is, but they're going to be going in the field with XRF guns or LIPS guns. LIPS measure the light elements, whereas the XRF guns, the heavier ones like rubidium, which are pathfinders for lithium, they're going to be going there. Where is this stuff? How big is it? How far under the surface does it stretch? And is it lithium enriched? Grab some samples and prepare for fall drilling. This will be the biggest prospecting wave in the history of Canadian exploration. And here's why. 1% lithium oxide grade at $10 a pound lithium carbonate, which is at the lower end, that's equivalent to 8.5 gram gold or 6% copper. And this will be an open pittable bulk tonnage system, anywhere from 10 million tons, obviously smaller ones, but those won't be interesting, up to 100 million tons, like Patriot Battery Metals, its Corvettes, going to come in with a resource estimate of 50 to 100 million tons of 1% to 2%. And it started off as an outcrop, but most of it's under a lake and visible. So this summer, all these juniors who have acquired these claims and can mobilize a proper crew will be in the field banging rocks. And what's interesting about this is the rumor mill that used to make the market fun in the 80s and the 90s, it disappeared. Everything became kind of like assay-based visuals. Nobody really cared until you had the actual assays. In fact, one little junior that I follow, Tower Resources, everybody was very excited by the visuals, but the assays turned out to be not quite what was hoped for. But when you're in the field and you're scoping out, oh, I got 1,000 meters of this, it's 50 meters wide, it's running this, those rumors from the field, those leaks, that's leaky. Assays, those are, that's very confidential. There are no leaks, there are no rumors. So we're entering a period of tremendous rumor mongering as these boots on the ground flood Canada, Saskatchewan, the Northwest Territories, Manitoba, Quebec, even Eastern Canada. And the public doesn't yet get it. They don't understand the value equation. Like, where do you find 8 gram per ton open pitable deposits or 6%? That's way back to the 19th century when the prospectors with their chasing skinny little veins, except we're not chasing skinny little veins like we did in way back then. We're chasing big blobs. And this is what I think is going to catch fire. And when we hit the fall, that's where the drill programs will happen, and they'll carry on into the new year. And what's beautiful about it is the world needs this extra supply. We don't know which ones will be the best one, where First Nations will end up being a problem, or there'll be some environmentally sensitive habitat that will get in the way. But this is now a collective race where most of the time it's like the winner take all type of thing. In this case, the majority of them could actually be winners. And I can't remember when we've seen a logic like that underpinning an emerging resource junior boom.
Fantastic. That's a good closing note. We're going to end on junior resource boom as the last 3 words that have been said. Fantastic. John, it was a tremendous pleasure having you on the program. Super insightful. I definitely need to do more research on the lithium side. Like, it's not my strong suit, I have to admit. So, because I was burned in 2016 and I'm scared to touch the stove again. Okay.
Yeah, well, I missed it entirely, so I didn't get any of those big buyouts that did happen for those who were patient.
So I need to get over that hump again, because I've seen so much stuff and so much tomfoolery back in those days, right?
The key is to understand the underlying logic of the climate mitigation efforts. Even if we get a Trump-style administration in the United States that pumps fossil fuel, the industry doesn't care. It's shifting towards electric vehicles globally. China has to, because oil import is a huge strategic vulnerability for it. So this transition, at least with the electric vehicles, this is going to happen regardless of whatever people end up in charge and want to change the policies.
Fantastic. John, where can we find more of you?
KaiserResearch.com. And for those, just watch my Kaiser Watch podcasts that I put out each week. There's a written component with graphics that I put together. I personally don't like to listen to podcasts because I don't have a lot of time, but the words are written there, which are sort of summaries of what I've talked about.
I actually used AI to summarize your last video. So it's really good. It works really well.
The audio?
The audio,
AI actually was
so
able,
you actually take
even with me stuttering and
it takes
hemming
it,
and
like
hawing.
It summarizes it in 5-minute blocks, talks about the companies you mentioned, and speaker also mentions FBX's Nittle Van project. I'm just picking randomly out of here. It just does it really, really well, actually. It's interesting. So it's a good summary. It's about a page long of your latest Kaiser watch. Really, really good. I recommend that. So
I guess I'm going to be out of business.
Well, you still have to produce the video.
It's when AI starts to invent it
the thing is, like, you can have AI speak the part for you. So you don't have to speak it anymore. So you can record your voice and it does it automatically for you. So you can write it and then it just does it for you.
So Metals Investor Forum will soon get rid of us speakers and just have AI avatars covering various topics that represent the focus of the companies presenting.
Maybe. Fantastic.
I hope not.
No. And on that bombshell, everybody, thank you so much for tuning in. We hope you enjoyed this conversation here on Soar Financially. Go check out kaiserresearch.com. Tremendous insights, especially on the bottom fishing part. Really, really interesting what John is doing there. Go check it out. Follow us here on YouTube. Hit that like and subscribe button. The subscribe button is roughly right there. Right there. I keep pointing out at it. I actually need to check if it's the right side I'm pointing at. Leave a comment. Leave a like. Thank you so much for joining us, and we'll be back with lots more.